Taxes. Nobody likes paying them, and companies in particular. In the last few months, we've had plenty of reports of how major multinational corporations like Apple, Google, Amazon are avoiding paying taxes by using clever accounting techniques and siphoning funds through offshore tax havens. That's a problem for governments because it means less money to pay for essential social services, for health and for education. The OECD is the place where governments meet to discuss this issue and to try to find a solution. And Pascal Saint-Amans, who is the head of the OECD Centre for Tax Policy and Administration, is the man who's in charge of this project. Pascal, thank you for joining us at INSEAD Knowledge. Can you tell us what is being done to address this problem?
If you do cross-border investment, you shouldn't pay taxes twice. And that's why for the past decades, we have developed instruments, tax treaties, model tax treaty, transfer pricing guidelines, and other instruments to eliminate double taxation. What is happening now in a globalized environment, with these rules which may not have kept pace with the way business operates, is that we face elimination of double taxation, but also cases of double non-taxation, meaning that the profit is not taxed at the source and it's not taxed at the residence because it ends up in a small remote island with no taxation. Now what we say at the OECD that we shouldn't put the blame on the business. The business, the companies are doing their job, which is to plan their taxes, to do aggressive tax planning. Can be more or less aggressive. Sometimes it's too aggressive, but basically this is legal. So if governments are not happy, and they have good reasons not to be happy, they need to change the law. You cannot increase the taxes on labor, on VAT, value-added taxes everywhere, and face cases for multinational companies not paying their taxes. Politically, it's not possible. You also need to face the problem of distortion between the large companies exposed to international transactions, which can plan, and the others, which are domestic, which cannot plan. So that's an economic issue. And finally, they do need money, and there is no reason for not collecting what they think is owed to them. When you have a corporate income tax of 35%, as is the case in the US, and the effective tax rate of some US companies, it's 2, 3, 4%, there is a gap hard to explain. There is currently $2 trillion of profits, accumulated profits, which are kept offshore in the US. So there is money out there that the government would like to collect. So overall, plenty of good reasons to say if it's legal and if we don't like it, let's change the law. And this is the project of the OECD that we call base erosion and profit shifting, the BEPS project.
How could we be sure that governments are going to agree to this? After all, they've been competing with each other for years to attract business from foreign multinational companies by offering them special tax favors.
For the past 15 years, what has happened is that governments accepted implicitly to decommission their own regimes to protect their tax base. The US has a regime which is called check the box, which allow big companies not to repatriate the profit in the US. In Europe, you have the dismantlement of CFC legislation, the legislation which are anti-abusive, and governments could live with that. But when you have the major financial crisis, which turns into a fiscal crisis, which turns into a political crisis, and maybe tomorrow a social crisis, you cannot tolerate that anymore. And that's why you have the politicians back on this. It's a policy debate at the highest level. The leaders of the G20 in St. Petersburg will talk about that. And there is consensus to say we cannot afford this divorce between the location of the profits in zero tax jurisdiction where no activity is taking place and the location of the activities. The markets, the emerging economies, the European economies, Latin American countries, the US, where you have the activity, but the profit is no more there because it's located in a zero tax jurisdiction. There is agreement, and even countries which offered some special treatment or some very flexible instruments or types of companies, like Ireland or the Netherlands, are supportive of the BEPS project because what they want is to attract real business. And the sham entity business is over. And I think there is agreement on that. Does it make everybody happy? Probably not. Is it good for the economy? Yes, because it will secure the fact that we can eliminate double taxation. And it will avoid having countries walking away from the consensus, walking away from tax treaties, walking away from transfer pricing and taking their own unilateral measures uncoordinated, which would be bad for the economy. So what is at stake is restore more taxation, to have a fairer tax system so that domestic companies are treated the same way as multinationals and there is no distortion left there, but also make sure that we are able, as the international community, to eliminate double taxation.
What will this mean for the companies themselves? If they pay more taxes, they'll make fewer profits, and that will leave them with less money to pay salaries to employ people.
What is important is that companies pay the right amount of tax, which is to be decided by governments. We at the OECD, we advocate policies which are to reduce the corporate income tax. And we think that these can go together. Look at what the UK is doing. I mean, the Prime Minister in the UK is saying, I want companies to pay taxes once. And he's very vocal about that and supportive of the BEPS project. But at the same time, he's turning the tax policy in the UK as very favorable to investment. Corporate income tax now is reduced to 20%. There is a number of measures such as a patent box, which is a way to tax at a very low rate the intangible income. So that's what they're doing. And what I think is going to happen is, on the one hand, strengthening the rules so that you cannot let it go implicitly. But if you strengthen these rules, to make sure that that companies pay their taxes at least once. On the other hand, you will have to be more competitive and offer regimes where you tax less. And this is compatible with creating, value, investments, at the end of the day, jobs, which is what countries need.
What about individuals?
Things are changing very dramatically in this area. Let's look back. In 2008, you had a key principle in many countries, which was absolute bank secrecy. I never cooperate with the other countries. That was the rule. And there were more than 50 countries having very strict bank secrecy. There was no such an easy thing as bringing the money to an offshore jurisdiction, a bank secrecy state, and hide and not report the income. That was very easy. In 2009, the G20, because of the financial crisis, said that's enough. We want countries to cooperate. Nobody believed in that. But in 2009, all jurisdictions, including Switzerland, Luxembourg, Hong Kong, Singapore, said we'll exchange information on request, where the information is forcibly relevant for the assessment of the taxes of the country which is formulating the request. So this was a big, major change. But between the commitment and the implementation, you need time. You need time to negotiate agreements. You need time to make sure that these agreements can be implemented, that you change the domestic legislation. And that's what we at the OECD, we have done over the past 4 years. We've made sure that the countries would change. We've put in place a global forum on transparency and exchange of information to do reviews. We have peer-reviewed 100 countries. We have made hundreds of recommendations, and these recommendations are followed. The British Virgin Islands, they had no access to the information. They had no treaties. They now have 30 treaties. They have access to the information. Switzerland couldn't exchange information. They have exchanged agreements with many countries. So major progress has been made, even though some countries are not making progress. Panama is refusing to make progress. Switzerland still has some progress to be made. What is happening now in the context of the G20, in the context of this long-lasting crisis, is that countries say, not enough, we want more. And more is automatic exchange of information. The fact that countries will have to report automatically to their neighbor countries or to their partners the opening of a bank account, the account balance of a bank account of a citizen of the other country. This is happening already with the US, the United States, through what we call the FATCA legislation, Foreign Account Tax Compliance Act legislation. The US is getting this, including from Switzerland, from Singapore, from Hong Kong. They are getting automatic exchange of information. And of course, the European countries now want the same.
So you're really expecting automatic exchange of information worldwide? Surely there'll be still a few tax havens that are resisting this.
Our goal is to level the playing field, meaning worldwide. We cannot afford doing this in Europe, and not worldwide. Otherwise, the money will shift, obviously. The Global Forum on Transparency and Exchange of Information includes 120 countries on an equal footing. It's the largest organization dealing with tax matters. And of course, we would like, if the G20 supports this, if countries move into that direction, that automatic UI be involved or be involving all the countries which are financial centers. So yes, that's the goal. That's what we are working out currently.
Pascal Saint-Amans, head of the OECD's Centre for Tax Policy and Administration, thank you very much for joining us at INSEAD Knowledge.
Thank you.